In July of 2023, the Bank of Canada announced they were increasing their policy rate to 5%. And after nearly a year of holding steady, they've since made 3 rate cuts to a current rate of 4.25%. And with inflation cooling, we can expect more cuts to come with 2 more meetings in 2024 and more beyond that. In this video, I want to talk about how these rate cuts could affect you massively if you're near or in retirement. And then I'll go through some strategies that you can employ in your portfolio to make sure you protect your investments and your retirement plan through retirement. For a lot of you near or in retirement, you've been able to enjoy the 4, 5, 6% GICs you've been able to lock into the last few years. But those gravy trains are soon to end. In fact, they have ended. RBC and all the other major banks had GIC rates on a 5-year term around 6% not that long ago. Now, if you walk into the bank or check online, you're looking at closer to 3.5% on a 5-year GIC. That's a massive drop in a very short period of time. And with more interest rates drops coming, that 3.5% GIC is soon going to be in the 1.5 to 3 range. We're going to see a reduction. And so what we used to see as a safe investment in GICs is now not there anymore. So that creates a bit of a problem, especially for retirees looking for consistent cash flow, reduced market risk, and longevity for investments. If you're not already subscribed to the channel, hit the subscribe button, join the community. We release 2 brand new videos every single week around tax, retirement, and estate planning for Canadians. So as many of you know, back in March of 2022, our interest rate in Canada here was 0.25%. It was basically free money, mortgages were rock bottom, and everyone was enjoying that. But things changed very quickly. 1 year later, we were over 4% interest rate, and again in July 2023, they peaked at 5%. Now they've started to drop down, and will they drop as quickly as they went up? Well, no, they're not, and we're already seeing that, and we don't expect them to drop that fast on the other end. But we do expect more rate cuts. And those rate cuts drastically affect those of you watching this video that are looking for a safe piece for your investments. Where can you invest and get that safe investment going forward, and how do you structure things? I've spoken to many of you over the last couple of years that have actually moved your whole portfolio out of the stock market or mutual fund or whatever you were invested in into 100% or close to 100% GICs. And maybe you've laddered it 1, 2, 3, 4, 5-year GICs, and you're averaging 5 to 6%, which in retrospect wasn't a bad option. Portfolios may have done a little bit better if you stayed invested, but it was safe. You could sleep at night, you didn't have to worry about it. But as those GICs start to come mature now, what's the plan going forward? And I think this is a conversation a lot of you need to have with your investment advisor. Maybe you're a DIY planner. You need to figure out, how am I going to do this? Because when my 5.5% GIC comes due, I can't go get that anymore. In fact, it's going to be 2, 2.5, maybe 3% on that GIC. And that just doesn't meet my retirement goals. Again, when we typically do a retirement plan in our office, we're looking at around a 5% rate of return. We try and build it conservatively. We think a 5% rate of return on average over a 3, 5, 10-year period should be doable. And it was very doable when you could get a 6% GIC. But now when you're at a 2 or 3% GIC, it makes it more challenging. So there's a couple other strategies you need to employ. Plus, one strategy that we employ for all of our clients and always have, that is bulletproof, that I'll share at the end of this video. So for many of you, you might shift back to bonds. Now, bonds leading up to kind of the interest rate cuts didn't fare that well. There's been years where bond funds have done well, but for the majority of you watching this video, bonds weren't a great investment. That's why you shifted into GICs. And for most of you, bond funds or bond mutual funds are really the only way to go, or a bond ETF. And you're buying a basket of bonds. It's not always the best way to go, but for a lot of you, that's going to have to be the switch back on the safe part of your investments. It's kind of the old school mentality of let's get money into bonds. Bonds aren't a bad thing. Just be aware that there's lots of types of bonds, risk, layers of bonds. Understand what you're getting invested into before you jump into it. Another alternative for you might be an annuity. Annuity rates have made a little bit more sense with interest rates dropping. They might make a little less sense, but it's worth at least running the numbers with your financial advisor. Again, a lot of you went into GICs because you wanted that risk-free return that the GIC provided. Yes, you were locked in, but you were okay with that. Annuity is fairly similar in that you're locking into it. Once you give your money into annuity, it's essentially gone forever, but it's guaranteeing you that cash flow. You're essentially buying yourself a defined benefit pension plan. Now, is the cost of that worth it? It might be, it might not be, but if you can get even some of your money into annuity and it provides a consistent cash flow stream that provides enough for you to do the things you want in retirement, it may be a solution as well. Again, we're trying to figure out where can you have that quote unquote safe money invested to allow you to sleep at night through retirement. A third option for you might be to stay in GICs. Yes, the renewal rate might be half what you had before, but at least you're still getting a 3%. It's guaranteed. You don't have to worry about it. But make sure you update your financial plan with your financial planner, because if you ran your plan at, which I see often, 8-9%, which I think is crazy, it's going to be really hard to get there. If you ran your plan closer to 5%, it's probably still realistic. If you're getting 3 on your GIC, hopefully you're averaging 7 or 8, a little bit more on your equity portfolio. Again though, if you're moving some of your money into GICs at 3% and you're still trying to get 5, you need some money making a bit more for you. You need to be invested in equity. You might need to take a little bit more risk with some of your money. And I'll talk about that here in a second and a strategy around that. But again, if you're going to go on one end of the spectrum, you have to go on the other end as well. And you have to be willing to take that risk. So again, this is the yin and yang of how to build a portfolio and build consistent cash flow through retirement. There's other investments out there as well that would provide fairly consistent return, cash flow, but there's always a risk to any type of investment. So make sure you do your due diligence. Again, the idea on this video is to say, look, your 6% GIC isn't going to be there when it renews. What are you going to do? And you need to start doing that research long before your GIC actually renews. Are you going to look at bonds? Are you going to look at another GIC at a lower rate, annuity, maybe a dividend paying stock? Again, carries more risk. So you have to figure out, like, what is your risk profile and what fits within that risk profile to give you the rate of return you need to provide the ongoing retirement income. So there's a few layers to this. Again, I really do encourage you to sit down with your financial planner to figure out what rate of return do I need to hit my targets. Maybe you can take less risk than you think. For a lot of you, if you've built up a good nest egg, don't worry about shooting the lights in retirement. Enjoy retirement, reduce that risk profile, build a plan at a 4, 5, 6% rate of return, something a bit more conservative that you can get almost guaranteed and not have to worry about your investment. So again, everyone's in a different situation here, but talk to your financial planner, sit down with them, update a plan, look at a few scenarios to figure out what's the best way forward for you. The final strategy I want to talk about, and something that we employ for our clients ongoing, and I really encourage you to look at something like this. A lot of people call it a cash wedge. I don't really have a term for it, but it's part of our retirement income program. So a retirement income program is essentially getting a plan built by our office and then having support on the investment side as well by a third-party investment counsel firm that we partner with. We'll put the link below. You can learn more about that program and the system and all of that. But essentially, to keep it in simple terms, what we do is once we build a plan, we know how much cash flow you need. And cash flow in retirement is king. If we know how much money you need and where that money is coming from once we've built a great plan, then we can match the investment strategy to the plan. And this is what all of you should be doing, but many of you are not. And so let's take an example that Sally needs $30,000 out of her RIF next year in 2025. What we'll do is we'll talk to the portfolio manager and say, here's the cash flow need. And they'll look at Sally's portfolio and say, look, based on the dividends coming in, we have about $10,000 of dividends naturally coming into the portfolio. So there's only another $20,000 of cash flow needs. Now, my concern for my clients and for any of you should be, well, what happens next year if the stock market drops 30%? If I'm invested in the stock market, I might be down 20 to 40%, depending on how it's done. I don't want to sell my stocks when portfolios are down. And neither do we. We don't want you selling your portfolio at a bad time, although most of you do, unfortunately. So what we do, or what the portfolio manager would do in that situation, is say, okay, of the 30,000, 10,000 is through dividends. We're good there on cash flow. The other 20,000, we're going to buy a direct bond. So one of the portfolio managers that we use for our clients or recommend for our clients buys individual bonds. Now, for an individual investor, that's tough to do. So again, a portfolio manager, one of the advantages is they can buy that individual bond, meaning that they'll buy a bond that matures in 2025. If Sally's cash flow need is 30,000 again in 2026, 2027, they'll do similar things. They'll buy another bond that matures in 2026 and one that matures in 2027. And those bonds still are getting 4 to 6, maybe 7% rate of return on a corporate bond. So we're still getting a decent clip or cash flow on that bond. The yield's providing it, but more importantly, and this is what I'm trying to stress to all of you watching this video, In 2025, when Sally needs her $30,000 out of her RIF, between her dividends and the bond that matures, it's there no matter what. She's not worried about stock markets going up and down. She's not worried about GIC rates, none of that. Her cash flow's there when she needs it. The rest of her money, let's say she had $300,000 in her RIF, she needed 30, the other 270 is working for her. Now, typically the portfolio manager will map out about 2 or 3 years so that we have that cash flow ready to go. But again, it's ready to go. The $10,000, that's dividends. So that money is still invested in equities. The bond portion is still getting a good rate of return. So the majority of Sally's money is still working for her. And this is, again, a cash wedge, call it what you want. But the idea is put 1, 2, 3 years of cash flow aside. And I don't mean put it in cash necessarily. Maybe you need to do that because you don't have a better strategy, and that's fine. But make sure that you invest your money or structure your portfolio in a way that the next 2 to 3 years of cash flow needs are ready to go. Now that all starts with a really good solid financial plan or a retirement plan. If you have a good retirement plan, you know where your cash flow is coming from. If you know where your cash flow is coming from, then you can actually structure the portfolio to match the cash flow. And guess what? When you do that, stress-free retirement. We've seen it for 18 years. I've been doing this since 2006, and I've seen it since 2006. That when you have a good plan and you match a cash flow and investment strategy to the retirement plan, it's fairly smooth sailing. Because again, you could turn that over. If 2025 is a good year, they're going to clip out a bit of the equity, buy another bond for 2028, and keep kind of moving forward on that strategy. Again, things can change. That's why plan update's good once in a while if things do get off track. But again, make sure you plan ahead for what your cash flow need is so that when times like this change, interest rates are dropping, GIC rates are dropping, your portfolio needs to adjust going forward. How are you going to adjust that? And how are you going to make sure you have the cash flow you need to enjoy, especially those go-go years of retirement?